Today's topic, I want to discuss cashing out your life insurance policy. So if you have a permanent life insurance policy, has some cash value in there, does it make sense to cash out that policy, surrender the policy, leverage that cash value towards a different, specific need, whether that's to set up a better life insurance policy, whether that's to replace it, try to receive some sort of income stream from those monies, try to invest those monies. What are some of the things to know? What are some of the common problems that individuals have when they're cashing out their life insurance policy? And then what are some solutions just always keep in the back of your mind to say, okay, maybe this might be, mathematically beneficial for my position, and how to use it the correct way. So the first things to know are, when does it make sense to surrender a policy, or kind of what does that mean by surrendering a policy? And if we look at a visual of how a typical permanent life insurance policy works, a very generic concept of it, we understand that premiums go into a plan and you have a death benefit that's associated with that plan. The higher the death benefit, the higher this cost of insurance and other expenses are going to be. So when somebody was going and they're placing their monies further into this plan, you have a portion of these premium dollars that are going into this plan that are being sufficed by the cost of insurance and other expenses to take care of the liability from the insurance company's standpoint to say, okay, when this person passes away, they're going to have a lump sum death benefit come off of their books, go directly to the beneficiaries. Now, anything that's paid in excess of the cost of insurance and other expenses, that's going to trickle into an account known as cash value. So kind of think of it like a savings account, or kind of like you're building equity into this sort of plan. So the way on how whenever somebody creates like a cash value maximization strategy is they want to lower the death benefit or lower this cost of insurance and other expenses so they could maximize the amount of money that's being contributed into this cash value. Also, the cash value grows by, if you had a whole life, it could grow by a dividend rate. If you had index universal life, it could grow by a different indexing strategy. If you had variable universal life, it could grow by sub-accounts like mutual funds. If you had universal life, it could grow by interest rates. So there's a whole slew of multitude of different types of permanent life insurance policies. The reason why I put this visual up on the screen is because this is ultimately how your plan is working, especially if you've been in it for a couple of years, even as far as 10, 20, 30 years into a plan. So you might have something that shows a specific death benefit that's sitting there, and then you're also seeing this cash value, or something known as cash surrender value. What exactly does this cash surrender value mean, and how can somebody take it, or what happens when they try to surrender their policy? What sort of monies are owed back to the individual when they're doing that surrender? So you might have heard the term known as FIFO, first in, first out. And what that's referring to when you're trying to surrender the cash value within a life insurance policy is based on the premiums that the individual placed first in. When they go and they surrender these monies, those monies are going to be able to go back to the individual tax-free first out. So if, let's say, somebody put in $100,000 into this plan and they look at their cash surrender value and that's only sitting at $90,000 and they want to fully remove all their monies, they could pull this $90,000 out because they placed $100,000 into it. Their cost basis was higher than what their cash surrender value is. They're not going to have a problem to go and take those monies and dump it back into their checking or savings account. Now, where the problem lies is when somebody, let's say, had put $100,000 into this plan, and instead of having $90,000 of a cash surrender value, now they have $300,000 of a cash surrender value. If they go and say, okay, yes, just give me all the money and just walk away, well, be mindful that they're going to be taxed on everything above what this cost basis is, so they would have a $200,000 tax over here. So you have to be careful when surrendering a policy, and when does it make sense to do it, and then what are some mechanisms that you can leverage, such as 1035 exchanges or replacements, to make sure that it's works most beneficial for your position. So when I say most beneficial, what do I mean by that? Well, you might be in a plan that has a very low rate of return on how that cash value is growing. So if you're in a whole life insurance policy or a universal life policy, an index universal life plan, you could have certain cap rates, you could have certain reductions in the interest credits that you might have been receiving 10, 15, 20 years ago, or even 5 years ago, and now those are significantly less. If you have lower cap rates and lower growth within the cash value of that plan, and there's a way on how you could take your monies, replace it, and have something that will give you a higher rate, well, then it might make more mathematical sense to do that. High fees. Also, what happens many times is individuals get set up with a plan everything sounds great. It sounds like rainbows and butterflies. Okay, you're going to have this much cash value by the time that you're, 15, 20 years into this plan. And all of a sudden they're looking at this, they're maybe in year 8, year 10, and they realize the original illustration looks nothing like what their account balance is sitting at. That's obviously a problem. It might be because there was a lot of hidden fees that were set up within those plans. So is there a way to go take the monies, place it into a different account altogether, or leverage a type of cash value maximization strategy that is more mathematically appropriate for your position? So that would be a high fees would be, a certain situation. Better opportunity. One of the things that constantly occurs is you have increases or you have adjusted mortality tables that come out. So as an example, let's say if somebody was set up with a policy before the year 2000, they might have been set up into mortality tables showing from 1980s. Mortality tables in the 1980s were showing individuals living significantly shorter lifespans than what they are today. Just like if you got set up in a plan that has a 2001 mortality table, or more recently the 2020 tables. What does that mean, and how does that correlate to receiving a better policy? Well, if it shows that individuals are living longer lives, then that's going to adjust the risk or the cost per thousand of what that liability is to the insurance company. So therefore, if there's a higher liability, that insurance company transfers that liability in the form of a cost of insurance. So if you have individuals are living longer lives, and actuarially through their tables, they're showing that this same individual or individuals that may be 40 years old that are getting set up with a plan today, they can have a cheaper cost of insurance than a 35-year-old that set up their plan 5 years ago because those mortality tables were adjusted. So all that's when I'm saying better opportunity, this could be from a pure cost standpoint to say, okay, if you're paying $500 a month into a life insurance policy and you could replace this, get the same exact death benefit, but now you're only paying $350 per month, why would you not do it? If it's the same quality of company, if it has sometimes they have even better features available, better opportunities, meaning you might have some long-term care related features or some terminal illness features that your old policy didn't have access to, those would be some of the reasons why you'd want to replace it. What I'm referring to, I say lower cost or no cost availability. What I mean by that is there might be a way that somebody could leverage their existing cash value. They do the 1035 exchange where they replace it into a new policy. And because that cash value is such a large amount, that cash value can now keep the new policy afloat where this individual doesn't have to add any further premium dollars. The cash value is ultimately paying for that cost of insurance each year. So you could have something that, let's say, has a cash value sitting at $300,000, has a death benefit sitting at $500,000. An individual goes, they're able to replace it, leverage company XYZ, whatever the insurance carrier's name is, and say, okay, if you go and you do this 1035 exchange in there, rather than you having $300,000 of cash value and this individual still placing in a couple $100 or a couple $1,000 per month or per year into this plan, they could go leverage this cash value, place it into the new plan, and that cash value is going to give them the permanent life insurance policy, making sure that that death benefit is preserved and protected until the date of death. So ultimately what it does is it saves all those extra years of paying monies out of pocket, paying premium dollars on a monthly and an annual basis because they have this paid up policy. And the sole purpose of this life insurance was to make sure that a death benefit was left over to those beneficiaries. In some cases, it might even be so extreme that, let's say if this individual had $300,000 sitting in the cash value, it might only require $200,000 to go and have a permanent paid up life insurance policy for that same $500,000 of death benefit, while they're able to now take this extra $100,000 and invest that and leverage this towards a savings, towards different investment brokerage related accounts or annuities or whatever that case might be. So there's so much flexibility when somebody could cash out of a life insurance policy. But once again, if they're set up in a good policy, it's not going to make sense to replace it. So all because you're hearing all these good features in this video of saying, oh, you could get this, and there's innovations. If you're set up in a really good plan and you've just been in there for a long time, and let's say that you're deemed uninsurable, it might make a lot more sense to stay with that plan, as frustrating as it might be, because it's going to give you significantly more benefit for yourself and for your legacy related goal than by doing a replacement. So just be mindful of all these different features and all these different variables that could come into play. So now that you know different reasons on why somebody may surrender or replace a plan because of all these different things such as, okay, if you have low rates, you get a higher rate. Obviously, that's a reason to change. You're paying high fees, you have lower fees. That's a reason to change. You have better opportunity, lower costs or no cost, like I mentioned. Death benefit, you could have more of either a higher death benefit, or you could pay less for that same sort of death benefit by doing the replacement, and then ultimately the better growth potential. Let's say you're trying to leverage a cash value maximization strategy and the rates of return are just not good enough, and you want to take those monies and roll it over and invest it into the market, that might be a solution that's more beneficial to your position. So, I hope that all this makes sense. Now, some of the problems that occur were typically overlooked is whenever you're going to take these monies out of and surrender your policy altogether, we'll realize you're losing those benefits. So typically when you have a life insurance policy, you have a death benefit that's associated there. Now, you might come to the point where that death benefit is no longer useful to you. You no longer want to have that there. You no longer want to leave a legacy, or maybe you're nearing that retirement age and you would rather just take the cash value because that cash is going to be more useful for what you're trying to accomplish. Well, when are there times that it works, or what are some of the problems to avoid by removing your monies from your existing life insurance plan or surrendering your existing life insurance plan? And the first thing comes down to surrender schedule. So as I clear up the screen, what I mean by that is these are going to be long-term related accounts, meaning that they're front-end loaded. And typically these cash value plans, if you're trying to use it for a retirement play, or you're trying to use it to be most beneficial, it's typically going to be a long time horizon. So something over 10, 15, 20 years to really allow these things to grow as much as possible. Well, if let's say you set up your plan and you had something that had a 15-year surrender schedule, and you decide, hey, I want to take all my money out. I see a cash value sitting here at $500,000, but you're not looking at the cash surrender value is only sitting at $350,000. If you go and you surrender this plan, you're only going to be able to walk away with the cash surrender value because there's a decreasing surrender schedule in there, meaning that you're going to get penalized by the insurance company for fully removing your money too quickly. So you want to be careful with that. So majority of the times, the surrender schedules are right around the 10-year marker, but some companies have them at 20 years. Some companies have them at 15 years, 12 years, 13 years, 10 years. Some have them at 5, 6 years. So it really just depends upon what this is. And you want to make sure that you're matching up exactly what the cash value is and the cash surrender value, so that if you're going to make a move, whether that's a 1035 exchange or you're going to do a full withdrawal out of this account, you want to make sure that you're able to net the most amount of monies, within that sort of plan. The other common misconception, or a lot of the problems that occur, are lost benefits. Like I kind of touched up on before, more on the death benefit side, but if you're trying to set up cash value and you say, okay, I want to accumulate these monies, be mindful that the cash value could grow tax-free, and when taken out properly with the correct carrier, be mindful there's a few mechanisms that work very well when it's going through a system of checks and balances with setting up a proper cash value maximization strategy. One in particular is the carrier that you're with. Well, if at that time when you're hitting that retirement age, you could pull these monies out in the form of policy loans. Some policies allow you to pull it out in the form of fixed loan rate options. Others have fixed loan, index loan, and variable loan rate options. So this allows you to essentially known as arbitraging your money, being able to take a loan out of this plan, so you're receiving tax-free income from this, and then you're leveraging the death benefit as a form of collateral that upon your death, the insurance company is going to get back whatever you pulled out in the form of not providing that death benefit proceed to your beneficiary. So like as an example, if you pull out $100,000 from your cash value, but you're doing that in the form of loans, and let's say you had a death, and this is just a really easy hypothetical example. Let's say if you had a death benefit that was sitting at $1 million, but then after you were pulling out these monies, this death benefit reduced down to $900,000 for really easy math, because you pulled out 100, so then it reduced the death benefit down 100. If you pass away, your beneficiaries would be able to receive $900,000, not the full $1 million. So you want to be careful on what are the benefits that are being lost, within this plan, or, does it make sense to leverage the type of tax-free growth strategy and tax-free income strategy to stay put within that plan, as opposed to if you remove it and you try to replace it with a new plan, well, then now that new clock might start off with saying, okay, now you have a new 10-year surrender schedule, or you have a new 15-year surrender schedule. So there's little mechanisms, there's little things that you could do to strip away all these miscellaneous costs. Some carriers allow you to have no decreasing surrender charges. So pretty much no surrender charges with this sort of account. So that might be more mathematically appropriate, where if you understand, hey, I'm going to retire in the next 5 years, 10 years, 15 years, I really want to leverage this cash value, I really want to leverage the tax-free growth on it, how do you set this up properly? So everything that I'm mentioning, at any point in time that this is appealing to you, and you want us to run a stress test, or you want to speak to a specialist about this, feel free to give our 1-800 number a call. It's 1-800-566-1002, and just make sure to reference this video so that we could have the appropriate advisor handle your situation. The other important aspect is loss of benefits if, let's say, you're deemed uninsurable. So insurability. If, let's say, you set up a plan when you were in your 30s, and now you're looking to get out of the plan, and now you're age 55 as an example, well, do you have diabetes now? Have you suffered a heart attack, stroke, cancer? Are you obese? Are you now a smoker? What exactly are some of the criteria that's occurred? Are you still insurable? Because if you had a really good health rating before, and now you're deemed uninsurable, and you decide, okay, I have this nice shiny object, I see this cash value that's sitting here, let me just cancel this plan altogether, and later in life I could always go purchase a new insurance policy. Insurance companies, they understand that risk better than anyone. They understand those actuarial data and those mortality tables better than anyone. If you're deemed uninsurable and you've already canceled your plan, you're trying to get set up in a new plan, you could essentially be shit out of luck and never be eligible for life insurance again because you surrendered your right. So that's where you just want to be careful there from the insurability standpoint. Loss of benefits, again, is going to be death benefit. So in some cases, individuals might have made that mistake where they got set up in a permanent life insurance policy when they should have maybe only used a term life insurance policy for a portion of what that safety was. And they added too much dollars into a permanent life insurance death benefit. So what do I mean by that? Well, let's say, typically when you're trying to create a proper death benefit for your situation, an individual would try to set up, okay, what do I have currently in debts? What do I have as an income play, meaning how much income am I going to generate from now until retirement? Do I have a mortgage? And then also maybe they want to, have some sort of educational expenses paid off upon their death, upon if they passed away in a short-term need. So like as an example, if let's say somebody has a personal loan out for $100,000, and they want to make sure if they pass away that their spouse or their beneficiaries are not burdened with that loan amount, they could go and say, okay, if I have my loan and it's going to get paid off in 20 years, maybe they could suffice this with the 20-year term policy. Income, if let's say they're age 45 and they understand they're going to be retiring at age 65, and after doing an adjustment of saying, okay, they make $100,000 per year, and they're going to be this income would have been going to their family members as if they were working for the next 20 years. That's $2 million of death benefit. If you deal with an insurance agent that's just trying to position you into a permanent life insurance policy, they say, okay, well, you need to have $2.1 million of permanent death benefit coverage to make sure your debt is covered and your income is covered. That might not necessarily be the case. Same thing with mortgage. If let's say you have a mortgage, you only have 10 years left on your mortgage, well, then it might make more sense to just have a 10-year term policy for whatever that mortgage amount is, and then also educational expenses. If let's say you have little ones, and those your children are going to be in and out of college, and all their college debt is going to get paid off within the next 15, 20 years anyway, well, why would you have that as a permanent life insurance plan need for your position? So when we fast forward, let's say if somebody made the mistake and they have $2 million of permanent death benefit, but all of a sudden they're now going into retirement, they might have a boatload of cash value sitting in here. I'm just going to use a $500,000 example. And maybe after doing an analysis and running back the stress test, say, you know what, I actually don't need a $2 million of permanent death benefit. All I need is $500,000 of permanent death benefit. So in this example, they could use the cash value. Maybe out of this, it would cost them $100,000 that they could go set up a paid-up policy for a $500,000 death benefit. So that will get paid out however long they live. If they pass away at age 90, if they pass away at age 70, pass away at age 110, this $500,000 will always go to the beneficiaries. And now they have $400,000 that they could leverage towards an income-related play, towards a growth-related play, towards ancillary-related accounts that they just kind of want to invest on their own. There's a whole multitude of different things. But in this example, loss of benefits, it might be beneficial to lose out on whatever that death benefit is, or it might be a huge hindrance. If, let's say, your major goal was to have $2 million get left over as a legacy to your beneficiaries, and you decide to remove all your monies or try to replace it, and you reduce this this death benefit down to $500,000, but you really needed $2 million, that's obviously a problem because now you're short $1.5 million off of what was going to accomplish your goal from a death benefit need. So, each situation is obviously different, which I'm just constantly repeating. And that's why it's very important that you're understanding and you're at least going through a stress test for your guys' specific situation to say, okay, is this mathematically appropriate for me to cancel this, for me to surrender it? What does it make more sense? Should I just leave this in my checking account, my savings account? Should I go try to invest that in other areas? Should I go try to create a whole new policy? Should I go leverage this for an income-related stream by leveraging an annuity with an income rider? How exactly does that work? So now I want to discuss in detail the solutions that you can create. So I'm going to go piggyback off of one of the strategies that we use. We set up something known, or we have a trademark process known as the retirement diet plan. Now, when we're looking at your situation and we're saying, okay, how does our retirement diet plan fit in to say, does it make sense to pull out monies from your cash value, do a replacement? How do you leverage those monies properly if need be? Well, the D in diet stands for distribution/income related planning. So if we understand that there's a gap between what your expenses are in retirement versus what your cash flows are in retirement, meaning Social Security income, pension income, any other forms of income streams that you may be receiving in retirement, if there's a specific gap there and you have, a decent amount of money that's sitting in the cash value, a couple $100,000, whatever, tens of thousands of dollars, how exactly could you leverage that effectively? Where there might be a strategy you could utilize as cash value, do a 1035 exchange, place that into some sort of hybrid annuity, trigger income to suffice what that gap is. So like as an example, let's say somebody has $500,000 sitting in cash value, and after realizing that their Social Security and their pension income streams are bringing in $50,000 of income, and their lifetime income expense throughout retirement is $60,000, well then there's a $10,000 gap here. This individual might be able to leverage a portion of this cash value plan, maybe use $100,000, do a 1035 exchange to a non-qualified hybrid annuity that's going to trigger a lifetime income stream for this extra $10,000 to suffice this gap. So out of this $500,000 of the cash value, now they have $400,000 sitting in cash value because $100,000 was used up to accomplish their distribution/income related need, the D in the diet plan. The I in the diet plan stands for investments or growth. So whatever you don't use up from an income strategy, you could leverage towards emergency and a growth related need. So maybe if this person still had the $400,000 remaining and they want to invest, they want to leverage $200,000 as a type of growth related strategy. And they're saying, okay, I wanted to go take these monies and utilize these dollars into some sort of accumulation play, whether that's super aggressive and they're leveraging investments or more conservative where they want to have a consistent rate of return or more of a fixed rate of return. They can leverage insurance companies, they can leverage bank-related products, they can leverage different custodians with brokerage accounts. So there's a whole multitude of different things over there. When they create these accounts, maybe out of the $200,000, they could create 2 separate or 3 separate or 4 separate accounts for $50,000 a piece that are now working simultaneously. That one set up for super aggressive play, one set up for a super conservative play, one set up for an emergency play, one set up for an index-related strategy play. And now they just took $200,000. They created 4 separate accounts. The first $100,000 that created one of the accounts to create an income-related play, and that already takes care of step 1 in the diet, which is the distribution. Step 2, which is the investment/growth-related plan on the I. And then when you go over to E, that goes over an estate/legacy-related plan need. So if you want to leave a legacy to your beneficiaries and say, if I'm 90 years old or 100 years old, I want to make sure that my beneficiaries receive something, then bam, you could leverage that remaining $200,000 and maybe purchase a new paid up policy or leave whatever that death benefit plan was alone, because this $200,000 would be more than enough to suffice paying the cost of insurance of whatever that death benefit was that you had set up there. The T is tax planning, where you could leverage this for if you have a specific taxable expense that you want to leverage the cash value plan for. You want to make sure that's set up into perfect structures of 1035 exchanges, replacements, the first in, first out type concept. So there's a whole multitude of different things. By just using one policy, you could take care of so many different things for your retirement planning aspect, or even just for a fund money aspect, for just using it as a splurge account. So don't just think, oh, you have to go and replace it and put into a new policy. You could go and actually leverage this towards a whole slew of different mechanisms that will put you in a much better position than what you're in right now, which is sitting with this one, generic permanent life insurance plan. And once again, if you're interested in us running a stress test for you, what we do is we look underneath the hood of your current plan. We say, okay, what sort of plan is this? What sort of in-force illustration do you have? When was your original illustration? What's kind of the difference? Like, why are you kind of looking at problems, or do you want to just make sure to test it out that it is still a good plan as compared to other plans available? That might be one aspect. Other aspects that are more important is really understanding a roadmap to your goals, understanding what you're trying to accomplish from now until your retirement stage, from your retirement stage until date of death, and making sure if there's a leveraging component with this cash value, how to do that effectively. Review your current accounts. If you have one account, you have multiple accounts, cash value plans, how to make sure to utilize those dollars, which are the different things that I mentioned in this video. And then at the end of the day, doesn't make mathematical sense to surrender the plan, to exchange the plan, or just leave the plan completely alone. And that's what we're trying to help you guys, figure out. If you did find value in this, feel free to give our 1-800 number a call. It's 1-800-566-1002. Give us a call, reference this video, and then we'll make sure that the correct advisor, is set up with an appointment with you guys. If, let's say, you want to set up a more concrete date and time that works best for your schedule, you check out our website. It's afasifinancial.com or retiresharp.com. I'll bring you both to the same place. And you'll be able to scroll down. You'll have a little pop-up that will have the calendar link will pop up, or you go click the contact button and you'll be able to have our digital calendar. Also, we just created a new feature to do a live chat with us if you'd like to speak more directly with the specialist or set up your appointment and you want to talk to a live rep. So that feature is on the bottom right-hand side of the screen. Chat with live rep. All you have to do is put your name, your email, and then start the conversation. You'll be sure to speak with someone directly. So we're trying to make it as easy as possible for you guys with the volume that we're bringing in through our different podcasts, through our YouTube videos, all of that. We want to make sure that we're able to at least, deal with your situation, make sure that we're providing as much value as possible so that you guys are satisfied on whether this might make sense or whether, it might make the most sense to just stay put and just have, further confirmation that your plan is excellent. So in closing, I hope that you enjoyed this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. And if you like this video, please give us a thumbs up and, leave us a comment, leave us any questions, and we'll be sure to respond the best that we can. But once again, thank you very much. Hope you enjoyed, and feel free to reach out whenever you need.